I'm speaking with Michael Karagianis, Head of Retail Partnerships and NFP, and a Senior Consultant at JANA. Hello, Michael.
James.
Michael, how is the credit market evolving?
Yeah, it's an interesting thing. Credit has become an extremely popular asset class over the last few years, and I think it's largely due to the collapse of interest rates, that hunt for yield globally that we're seeing, that really people are looking to supplement their portfolio returns, and credit has really come into focus in that environment.
So what role does credit mainly play in portfolios?
Yeah, it's part of the fixed income asset class as a whole, but really it's quite a distinct category. And I think one of the points that we're very keen to stress is that fixed income is not homogeneous. There's a world of difference between high quality sovereign debt, which traditionally we'd have put into a portfolio to provide return, but importantly diversification. If equity markets fell, fixed income markets would do well and provide some balance. But credit is what we would call a middle risk type investment, where in certain environments like what we saw last year with the COVID sell-off in equity markets, credit actually followed equity markets down in many respects. And so it doesn't necessarily provide the same diversification. Therefore, we'd be cautious about suggesting it as a defensive asset class. It is more middle risk in nature.
So did it largely do what its holders thought it would do in that extreme test of portfolios that COVID brought on?
Well, yes and no. I think that certainly it has delivered extra yield, and that is what most people were looking for. Global bond yields went really down to not only multi-decade but multi-century lows in yield, and hence not delivering those returns. Credit was an obvious replacement, and it did deliver that. Credit funds have done very well over the course of the last couple of years, delivering double-digit returns. But during that particular period of the COVID sell-off, we actually saw a lot of credit funds falling 10% in value. Now, equity markets were down a lot more, but they didn't really provide the diversification that people were looking for.
And now, Michael, and going forward, in light of the extraordinary policy environment in which we live, in terms of government and central bank policy and its impact on bonds and sovereigns in particular, is credit now being looked at as a discrete allocation and one that really does what bonds used to do?
Yeah, I think that certainly we are seeing, as I said before, a lot of focus on credit, and it is becoming a larger part of portfolios. I'm not sure that it will always be viewed as the replacement for high quality debt. So I think that, in normal market environments, you can probably get away with that. You'll get away with the extra return that is engendered from credit. You will have some diversification benefit from credit, but people do always have to have at the back of their mind, in a very stressed market environment, it's not going to behave as we would normally consider traditional fixed income to behave. And that is the sting in the tail, potentially.
Michael Karagianis from JANA, thanks for your time.
Thank you.